In the last 6 years that I've been covering banks and asset managers here, it's only been in the last 2 or 3 that you've been showing up to shareholder meetings and seeing shareholders significantly grill CEOs of the companies on how they're making changes at the companies. From the both of you, I'd be very curious to hear about the historical perspective. Obviously, trillions of dollars flowing into the asset class. Where did we start and how far have we come from your perspective?
So firstly, it's great to be here, and it's good to be in New York when it's snowing, so at least it's not sunshine, and we can talk about climate change later on. But it's, this is, impact investing is really a journey and not a destination. And so if you go back many years, it's a little bit very similar to when I was first investing in emerging markets in the 1980s. And it was a new phenomena. There was a lot of opaqueness. There was a lot of confusion. What is emerging markets? What's not? And today, that's a standard asset class. So similar to this, I think the way we view this at Nuveen, firstly, going back 50 years, we've been our parent TIA has been involved in impact investing for over 50 years, right from the time that we made our first investments in South Africa during the apartheid movement and took an activist view at that time. So it's just become known today, but we've been actually involved in impact for about 50 years now. And the way we view this from our $1 trillion under management, 1.1 trillion, 100% of that has incorporated in our investment process the UNPRI principles. About 30 billion of our $1 trillion is in ESG, and about 5 billion is in impact. So this is really a journey, not a destination, and we can talk a little bit more about how that is measured, how it is viewed, different asset classes. But I think we've come a long way. We would not have had an audience of this size even 5-7 years ago. So I think that is becoming more and more mainstream.
You also take a very optimistic view on how far we've come so far. So I would love to hear your perspective as well on.
So I think every few years, or sometimes every few decades, a new investment theme, a new way of looking at investment categories emerges. And we're seeing today a new theme, which Peter Harrison of Schroders has described as a mega trend. And the theme is that investment cannot just be about making money. Investment has to be about making money and about improving lives and the planet. It's been driven by a major change in values in a younger generation, which is interested in playing a full role in improving the state of the planet, but also the lives of people with whom this generation is connected through social media and empathizes. Over the last few years, these changes in consumer values have made investors aware of the fact that they are changing the prospects of the companies in which they invest. Okay? And when the investors began to direct very substantial money, 30 trillion today is going into ESG, mainly with the purpose of not doing harm, rather than finding specific solutions to social problems, which impact investing tries to do. $30 trillion is not an insignificant number anymore. It's more than a quarter of all professionally managed money in the world. And so now we see companies becoming aware of it. You see the Business Roundtable coming out and saying our responsibility is no longer just to shareholders, it's to stakeholders. And you see a similar group of European companies, about 40 of them today, that have come out with a Business for Inclusive Growth strategy, which President Macron has been pushing. The destination is going to be very relevant to each and every one of you in this room. The destination is going to be impact-weighted financial accounts, and they're going to come sooner than you expect, like within the next couple of years. Within the next couple of years, you will begin to see financial accounts weighted initially for environmental impact, and then for employment impact, and finally for environmental impact, employment impact, and social impact. So we are going to find ourselves using the tools of financial analysis on impact-weighted financial accounts. And as Warren Buffett famously said, when the tide goes out, you see who's swimming without bathing trunks. So companies are going to have to start now to measure their impact, to report on their impact in order to satisfy the demands that are being placed on them.
I do want to get to reporting, but before we get to measurement, I want to get to definition. You had mentioned the Business Roundtable, but the Business Roundtable has gotten a lot of criticism for not properly defining what it is they're trying to accomplish. And even in ESG, you do have a lot of competing forces. Is it gun control? Is it oil and climate change? Is it diversity on boards? When you all look at E, S, and G, where are we making the biggest strides, and how do you make more strides in the areas that we're not seeing enough progress?
So I think, again, I go back to history that firstly, the arrow has left the bow. And today, there's not a single asset manager, asset owner, corporate entity that is not in some stage of the journey on impact investing or ESG. Yes, there is confusion. It starts from the way, especially for endowments, is philanthropy, where there's really no expectation of return, to ESG, which is more of a filter and excluding certain stocks or certain industries, to engagement, which is really investing in firms which are not necessarily today at that stage of ESG or impact, but where we as portfolio managers are engaged through whether it's proxy voting, whether it's dialogue with management, engaging with organizations on whether it's on child labor, environment, sustainability, et cetera, all the way to impact. And so I think this entire journey that we at Nuveen, as I said, from the $1 trillion, 100% is included. We use a lens of the UNPRI, but then there are different stages of, so there is confusion, there's no doubt, but I think as we continue to measure and define certain, clarify certain definitions, you're going to see more and more clarity over time. But it's a little bit like the global investing on emerging markets, where in the 80s you had the same confusion, and today I think with measurement, with categories, today it's pretty clear what's an emerging market and what's not. So I think you're going to see the same in this space as well.
Circling E, S, and G, where are you seeing the most progress?
So the greatest progress has been across the three categories without any measurement, but with an intention, at least to avoid harm, as Vijay was saying. It's been growing at a vertiginous rate. It was 22 trillion 2 years ago. It's at 31 trillion now. If you look at within that, at the bit which marries intention and impact measurement, which we call impact investment, it's $500 billion. It's doubling every year. When we wrote a report about this in 2014 called The Invisible Heart of Market, we talked of the first $1 trillion. Well, it looks like the first $1 trillion is going to be achieved in the next year or two in impact investment. So both are growing very quickly. But it's easier to measure impact today if you're dealing with the private asset classes, private equity, venture capital, real estate, infrastructure, because you're measuring specific interventions. When you're dealing with a global company with multiple product lines across multiple countries, we need new ways of doing that. So the challenge, as I see it, is the world is shifting from optimizing risk-return to optimizing risk-return impact, right? We need that because if we don't do that, governments can't cope with the consequences of private sector is creating.
You had mentioned to me earlier that you had done a lot of work with endowments, with different endowment boards and whatnot. How much pressure is coming from LPs to different private investors to do more in ESG?
A lot more than previously. That's why you see some of the leading private equity firms, KKR, Partners Group, Bain Capital, Blackstone, Apollo, all launching impact funds of one kind or another. The pressure is coming through. The problem is if you don't measure, it's quite difficult to know what you're actually investing in.
So in fact, just today we've published and we've launched Nuveen's impact measurement on our private equity portfolio. And so two of the measurements that we kind of quote is today our impact is roughly, we've reduced the CO2 footprint by about 2 million metric tons. And this was about 80,000 metric tons 5 years ago. Same thing with recycling. Today it's 80,000 tons. It was 2,000 tons 5 years ago. So on the private equity side, it's easier to measure because it's fairly specific. I think where the industry will have to go is how do you do that with the public markets? That's where there's some amount of confusion. But the public markets or mutual funds, closed-end funds, is where you see democratization of this move. Because the private equity endowments, DC plans, institutions can invest in private equity or real estate, ag, timber, and have a clear impact. The question is, as $30 trillion gets inherited by millennials over the next several years in the United States alone, how do they make an impact on society, become stewards of the globe with their amounts that they're inheriting? And so I think that the vehicle is going to be important over time.
I'm glad you brought this up because you do have a lot of liquid products at Nuveen, obviously, ETFs, target date funds. How do you, but when you look at Nuveen's website, for example, all of these asset classes are kept separately. And responsible investing, impact investing is an asset class of its own. And so how do you start to integrate all of these efforts you're making into all of your other products that you have?
So first I want to clarify something. Our brand association really is on 3 pillars. First is income. We've generated income for over 100 years, both on the TIA side and the Nuveen side. Second is alternatives. We have about 30-odd% of our AUM is in alternatives. But the third, which is very relevant for this audience, is on responsible investing. Within responsible investing, we slice and dice the journey separately. So we say the entire $1 trillion has an overlay or a lens for responsible investing. And that includes ESG, it includes engagement with management, it includes across all types of relationships that we have on the listed side. The second is ESG, which is purely an asset class. So the first is not an asset class. The first is embedding it in our investment thesis. The second is ESG, which is an asset class. And then the third is the impact investing, which is mostly on the private side. We are now incorporating, we announced that a few years ago that the Paris Agreement, all our real estate will meet or surpass the requirements. So about 42% of CO2 emission, which is more than cars and airlines, comes from the real estate industry. And we have agreed that all our buildings will meet or surpass our own determined targets, whether it's with LED lights, whether it's recycling, whether it is solar, et cetera. So each firm is kind of doing it at a different stage. And measurement and disclosure is going to be far more important.
So speaking of CO2 is something you brought up twice now already. And going back to a prior question, how do you prioritize what's important to you when it comes to looking at the companies that you invest in?
Yeah, so there are 17 SDGs by the UN. We have decided that while all are important, are 3 verticals where we have intellectual property and to leverage our investment thesis. One is on hunger, and food because we have a fairly strong presence in timber and ag, etc. The second is on affordable housing. We are very big in the real estate business, so we can easily expand into that space. And the third is financial inclusion, where we've been doing that for a long time, whether it's microfinance, microcredit. And then, of course, the overarching thing is on climate change. So those, you can't do everything, you can't be everything to everyone, but we have 3 areas of special expertise which we're kind of trying to leverage our traditional asset management into impact.
We're seeing across the world today political polarization, which sometimes erupts into violent unrest because of inequality. Okay? The reasons this is happening are not just political. The reasons are economic, because our system today has created a spiral which leads to those who have capital getting richer and richer, and those who are at the bottom of the pile being permanently stuck there. Okay? So our economic system has to change. Some people view it as an evolution to begin to incorporate impact, and some people view it as a revolution. Okay? The fact of the matter, I believe, and I was privileged to be involved in the early days of the venture capital and tech revolution, we're going to discover that those who optimize risk, return, and impact best within every asset category can deliver better returns than those who just optimize risk and return. And the reason's important. On the one hand, you reduce the risk of the company because the risk of taxation, regulation, talent leaving you, consumers deserting you, and so on is reduced. But at the same time, you open the door to new sets of investment opportunities, usually at lower price levels, addressing the needs of much broader populations which have previously been excluded. Okay? Now, in the early days of the venture capital industry, everybody thought, how can these young college dropouts achieve anything? You know, now it's between private equity and venture capital, $7 trillion pool. It's brought us the tech revolution. The same young people are innovating with business models which are designed today not just to lead to a unicorn being worth $1 billion, but to a unicorn also improving the lives of 1 billion people. And it's real. You see it in the deal flow of venture capital funds and even private equity funds today, like those I mentioned. They're trying to address major issues through their investment. The returns, in the same way that venture capital delivered superior returns, in my view, will be superior. The problem that we face today is that the amount of capital coming in looking for it is proof of the demand for this, right? 30 trillion isn't just a fad. 30 trillion is a trend.
Something very interesting about what you said is we were coming off of WeWork. And so we're in this era where so much private capital has flushed into private markets. Every venture capital I speak to these days say that governance has run wild. That's a major part of this. Do you believe that there's a turning point here, and what can the largest investors, the LPs, do to kind of turn around the wheel in terms of?
Yeah, I think, one hears only about the big sensational news, but if you look at today, nearly 48% of our RFPs have a question, and it's not a passing question or a subset, about what we are doing on governance or the environment. And I think when we are up in the finals and we are debating our investment thesis, investment capability, it comes out very clear. It's not just a side comment, which it was maybe 5-7 years ago. Today, you have to have an in-depth conversation. And I think both asset owners and asset managers, the asset owners who are investing with us and we as asset managers, have to have a very clear and precise thesis in order to actually win that mandate. So I think, as I mentioned, I think the arrows left the bow. We are taking 2 steps forward, 1 step back. But I want to also touch on one other point that was mentioned earlier, is that today as a manufacturing firm, it's not about the old days like Milton Friedman said, your returns are the be-all and end-all of the organization and it's your shareholders that you work for. I was talking to a CEO of a large organization 3 or 4 years ago, and she was telling me that I have to fight for talent. So 40% of my employees are millennials, and I cannot retain those millennials as employees if I don't have a view as a steward of society and of the world. And over 50% of her consumers were millennials. So today for CEOs, it's not only about asset owners and investors who are asking this question, but it's employees and their consumers. And therefore firms are forced to move to address this. And I think the next phase will be how do you measure that?
And just like the tech revolution, the disruption is going to come for younger firms. And I want to just share with you an example I came across quite recently. As you know, tech is a big thing in Israel, and there's a company called Orcam, which has designed a pair of spectacles for the blind. Okay, the owner's aunt was going blind. He had a startup in the carless driver or driverless car area, and 6 years ago he said, "My technology can help my aunt," and he created a pair of spectacles that whispers into the ear of a blind person the page of the book they're holding, or the newspaper, or the value of the banknote in their hand, and so on and so forth. Companies raised $100 million. Last round was $600 million valuation. You'd say, wow, that's a great impact venture. Okay, it's improving the lives of 35 million blind people, maybe another 300 million visually impaired people, and it's going to deliver a great capital gain for the investors. But if you begin to think like the new millennial generation, and you begin to add impact to risk and return, you ask yourself the question, how can this technology help the maximum number of people? And it comes up with a very surprising answer, which is, what if you use this technology to give these glasses to 800 million illiterate adults in the world? What would that do for the lives of 800 million people, the economy of their countries, for the global economy, to bring 800 million people into more productive work, right? And the business model implication of that is that a company like Orcam is now thinking of a market of 1.1 billion people instead of a market of 330 million people, okay? So the question, I think, for each and every one of you in this room who's thinking about investment is, do I invest now with impact in mind? Is it going to lead to better financial returns? Is it going to lead to improving the world at the same time? And the answer, I mean, how many of you would be attracted to the idea of investing in a company like Orcam? Would you raise your hand? Okay, a bit higher so we can see. Okay, I mean, like, most of you. So I think the examples exist everywhere, and you can see them across the world. This isn't like the tech revolution, Silicon Valley, and maybe Israel and a few other places around the world. This is an area, this area of impact investment. This is an area where every country has impact entrepreneurs, big social issues, and so you can expect to see this, in my view, be as much of a revolution as the tech revolution was. The impact revolution will be just as great.
I'm really glad you brought this up on the entrepreneur side, because, Vijay, you brought up a concept earlier that I wanted to revisit, and that's activism. You mentioned TIA was an activist during the apartheid era, correct? So I would love to hear a little more about what that means moving forward. What kind of role in activism can a big investor play when it comes to how you're putting your money to work?
So I think in the old days, activism was more to unlock value. you were an activist investor in a particular firm so that you unlock value of that stock. So it started, and that was where hedge funds and others kind of went in. I think the evolution of activism is more about risk mitigation. So today, having minorities or more women, on boards, or voting in a particular way as stewards of society, helps to mitigate the risk of your investment. So it's not only about the upside capture of unlocking value, but it's also about downside. And so I'll tell many of you know that Nuveen is highly recognized because of our muni business. So one would imagine you're buying muni bonds issued by government, so how is impact involved in that? But today, with the wildfires in Southern California or the hurricanes on the East Coast, when municipalities issue their muni bonds, there is not a single prospectus that does not talk about climate change or the impact that they are having in that particular county or that state. So I think investors today are looking at impact not only from unlocking value on the upside, but also mitigating risk on the downside.
So I want to get to financial reporting, and I have your phones ready. I'll ask everybody in the audience about this in a second also. I would love for both of you to answer, I know it's very important to you, on how you believe we could be measuring impact reporting more aggressively, and to what extent do you think that they will be required in terms of more companies and how they report to their investors?
So there are about 150 serious attempts around the world today to measure impact of one kind or another. And we need to bring them all together. And that's why I chair an initiative incubated at Harvard Business School, which I, being the chair of the Global Steering Group for Impact Investment, a joint initiative with the Impact Management Project, which brings couple of thousand people from across the world who are working in the area, to arrive at what must be the destination, which is impact-weighted financial accounts, as I said, where your consumer impact, the impact of your product on your consumers is measured and added or subtracted from your sales line, where the impact on your employees and employees in your supply chain is measured, and again, an adjustment is made, and where your environmental impact is measured. In 1929, there was a huge crash, as you know, and following that, people woke up and they said, it can't be that when we're looking at two companies in which we're investing, they're following completely different accounting principles. They pick their own accountants and nobody verifies it. Immediately after that, there was a huge change. The SEC was created, we shifted to accounting principles, to GAAP accounting principles with the use of auditors and so on. I think we're going through the same thing today. I think people are sitting up and saying, we don't measure impact. We should be able to measure impact. It's a lot easier to measure impact than it is to measure risk, which brought a transformation of portfolios over the last 60 or 70 years. Helped change portfolios to include venture capital and private equity, investment in emerging markets. Prior to that, every pension fund or every endowment had two securities in it, the bonds of the country and the stocks and shares of the country. And this risk thinking transformed investment portfolios. So if you look at the big picture today, we had 2008, which was a major shock to the system with all sorts of repercussions. And now we're sitting up and we're saying, you know what, with existing technology, with the problems the world faces, we have to measure impact. And it's possible to measure impact. And the destination will be generally accepted impact principles. Alongside GAAP, you're going to have GAPE. And companies are going to have to report that. First of all, because big investors like Nuveen and TIAA, CREF and so on are demanding it. And secondly, because governments are going to come to understand that a system where the private sector creates terrible consequences, which governments have to tax us all to try to remedy, just doesn't make any sense. So to answer your question, I think what we're going to see over the next couple of years is governments beginning to tighten up on reporting by companies, requiring companies to report on the three major sources of impact which I have described.
I'd love to also ask the audience also, if we could pull up the polling question, do you believe that impact measurement will become a part of financial reporting? Should be coming live in just a few seconds. Wow. We're pretty perfectly,
Oh, wow.
perfectly split. Vijay, do you have any kind of
So
responses to what we're seeing?
absolutely, I think the next several years is not about money flowing into responsible investing or impact. I think that's happening as we speak. Just for this audience, we are going to be, pardon the word, impacted by negative news over the next several years because people are doing a lot of greenwashing. They're measuring things in a different way. There's no consistency. So we as a society, we as the industry need to take charge. Before government agencies start getting involved more actively and forcing us, we need to start self-reporting. And whether it's with the United Nations, whether it's IFC, whether it is with the GIN, I know Amit is there, he's going to speak later on. We as investors are very actively involved to make sure that we can measure the impact and then share that with the community so that there is a critique. And over time, there is consistency between us and other portfolio managers. In a mutual fund, for example, if you invest in Australia or Europe or the US, and you know it's a Morningstar 4-rated or 5-rated, it's consistent. Everybody understands what a 5-rated Morningstar fund is. In impact, that's yet opaque. And so that's the next wave where a lot of academics, a lot of empirical information is actually going on.
I'd love to open up to audience questions now as well. I know we'll be touching on some of this throughout the rest of the panels as well. Does anybody have a question for our panelists?
Yes, thank you. Hi, as Sonali said, I'm Lauren Keel. I'm going to be here to ask your questions of all of our speakers. So just a reminder, you can submit them by using our Summit app. So if you go to GRIF 2019, that's GRIF 2019.app. Once you get there, you're going to look at the bottom bar. On the far right, there's one that looks like a speaker bubble with a question through it. You put your questions there, they'll come right to me, and I'll be asking them to all of our speakers. So while you submit those, I know we got a lot of people standing. So if you have a seat next to you that's open, will you please raise your hand? There's a lot of them here in the center. So everybody around the edges, if you want to come in, feel free to. You don't need to stand. There's a bunch here. All right, let's take some questions. So first one, do you think that the growth in responsible investing will continue indefinitely, or will it start to taper off at some point? And if so, when do you think that will be?
I think it's going to become, it's not a wave. I think this is a journey which will be part and parcel of the entire industry. Incorporating responsible investing as a lens. It's like calculating IRR for a project. This is going to be part and parcel is what is the impact to society in general. So I think it's here to stay. I don't think it's about growth. It's about incorporating it into the entire asset management and asset owner industry.
So Ronald, would you like to add?
Yeah, I would agree with that. I think it started out as an asset class because you needed allocations for it, and then you could say, I have an allocation to impact, and it can go across other asset classes. But at the end of the day, it's a change in investment thinking, and it'll go across all of the asset classes. I think it's a mega trend. I don't think it's going to decline.
Can you say more about ESG and greenwashing, and specifically, how do you evaluate for greenwashing? How do you make sure that you're not investing in things that are...
So we've all lived through fashions in the investment world. I remember in the mid 80s and early 90s, if you added Tronic to the name of your venture, then all of a sudden the valuation shot up, and we have seen evidence again now in the tech space and in spaces purporting to be tech of massive valuations, which aren't really justified by the substance of the company. That's happening today in the ESG space. It's a very good way to raise capital because there's big demand from both private and institutional investors for it. And so I think investors have to be increasingly demanding of companies so that they don't get away with just throwing bits of the positive impact they create without measuring the negative impact they create.
Yeah, and I think boards have to be comfortable with the negative press from time to time because we are being judged with 20/20 hindsight. And this is a journey. So until we have a purely scientific measurement, you're going to see some people take advantage of greenwashing, some investors coming for, there are going to be lawsuits. But I think all in all, the direction is towards measurement and incorporation. And so I'm personally very optimistic. I think the cup is half full and not half empty.
We have a lot more, but unfortunately we're out of time.
Yeah. Thank you all so much and see you later today.